Welcome to Making Your Miles Count Production, an educational program to all Canadian lease owner-operators with your host, Robert Scaper.
Welcome to Making Your Miles Count podcast. Today we're going to be dealing with a subject, medical expenses in Canada. And we're going to be dealing with all of Canada, not just one small area. And what you actually should be doing with medical expenses through the year, and maybe in times of the year. Maybe some years you have large, some years you have small. What is your general approach should be towards medical expenses when you're in Canada? And as we're going to find out, there's an awful lot of detail that have gone, there's many hours that have gone into the research, into actually showing you what kind of return on investment you have with medical expenses. Medical expenses has been changing. There's been laws that has been changing, and the government trying to give us more and more stuff. But when it comes to actually getting a medical expense, let's say a pair of eyeglasses, what do you actually do with it? Do you hand it in? Do you not hand it in? What do you do? That we want to deal with that today. And probably one of the, in my opinion, the best research I've ever done, especially in the medical industry. I went into it probably about 6-7 years ago. And because I had a lot of staff, I have 35 staff. And what do? Do I go out and get a medical plan and, all these different things? What is the best return on the investment for the amount of money that we put into a medical plan, for instance? And everything that I researched was actually quite expensive, not necessarily for me as much as even the employees. And what kind of, if I put in $1, how much are they going to actually benefit? And I found that a lot of what's available out there from insurance companies are extremely expensive, and I was under unique circumstances because I have relatively a very young staff, and so when I stumbled across corporate care and I guess they would call medical trust, it took a couple of years, and then I made the decision, and now all my staff actually use a medical trust, corporate care. And today we have with us, would you like to introduce yourself, Margaret?
Sure. So I'm Margaret Koniuck. I'm the founder of Corporate Care, which is a program that helps business owners provide health benefits for themselves or their employees. I'm a CPA. I've been running this business since 2000, so 24 years, seems like a long time now. We're a company that understands the small business market, so we try to design the program always to make it as easy as possible for the small business owner to use this program, and also keep our prices as low as possible. So we're always looking for ways to make how we operate this efficient, so that we don't have to raise our fees, which we haven't raised since 2005. And I don't see us doing an increase in fees in the near future thus far. So yeah, and I think this is I like this program. I like working here because it's a hidden, not much known, and needs to be better known little treasure for business owners, because the long and the short of it is it saves you taxes.
Mm-hmm.
Very tax friendly program for money that you are expending anyways as a personal medical expense.
Yeah, I think I heard about you first on the radio. You were on CBC radio or something like that. That was
Yeah, probably CJOB. Yeah,
JOB. That's what it was. Yeah, out of Manitoba, or does it go all across? Or
no, I think that was probably Manitoba based, most likely. Yeah.
Okay, that was a number of years ago, and the result of the medical trust, the system that you have, the recipient actually receives a non-taxable benefit, correct?
Correct.
That's right. And our firm, we love non-taxable benefits. That's what our entire industry is based on. And so it dovetails very nicely here. But maybe what we should possibly do right at the beginning is maybe explain a little bit how the system works, and then we'll move on towards what the actual return on your investment is.
Sure. So I'm going to start from the perspective of what I'm going to say is a business owner or an owner operator. Does that make sense?
Yep.
Perfect. Okay. So as a business owner or an owner operator of your own small business, you generally would have some medical expenses between, if you're a single person or if you have a family lump sums of medical expenses. If you went to claim those on your income tax return, the first sets of money isn't allowed as to be claimed for the medical tax credit. So and the calculation goes 3% of your net income to a maximum of it's $2,635. You can't use that first part of your medical expenses to claim for the medical tax credit. So on your personal income tax return, if you make, say, $50,000 or so, your first $1,543 of medical expenses don't get you any kind of return on your personal income tax return. So, and a lot of people, that's where they sit. Their medical expenses are in that realm, or maybe a little bit more, but you're really not getting much for it. But if you go through a program like Corporate Care, as a business owner, from $1, you get a tax credit, or a tax benefit, I should call correctly, on your medical expenses. So on that $1,500, you would actually get back as a tax-free benefit, or a tax benefit to you, approximately $372. Where you would get nothing if you use the personal, if you tried to just use them on your personal income tax return, but if you put them through your business, which is a program that Corporate Care does for you, you would actually end up pocketing back $372 on that $1,500 of medical expenses. So
I'd like to interrupt.
Sure.
What we're describing is two completely different systems on how to deal with. You have one receipt. You either have to, you can either use it on your personal income tax, or you can use it when you're busy. It's two systems, and
Perfect.
You can't do both. But it is two different systems, no different than, for instance, what we do, the TL2 simplified method versus the non-taxable benefits. You can't use both at the same time. But so in the Canadian income tax system, we have choices. We can do one thing with something, or we can do another thing with something. And there's usually the easier way brings a lower return, and the more difficult, the more focused an individual has to be, you get a better return on it. And that's the principles that I see that are operating in here. And so the mindset is, okay, I either choose this or I choose this. Which way to do it? And you're working with the incorporated format of that. Okay, sir, go on. I couldn't resist there for a second.
Sure, no, and that was great. I think you really kind of simplified it and explained how the difference is. You have options, and you're absolutely correct about that. And just a little bit of an expansion, you don't have to be incorporated. You don't have to be an incorporated business owner to use this. You can be a sole proprietor.
Oh, really?
It works in the same way, except, and maybe we'll just get into it just off the hop here. CRA puts a little bit of limits on you as a sole proprietor. You have to, your business income has to be your main source of income for you to use this program. because they don't want someone who's has I'm just going to pick an industry like you're a teacher, and then in the summer you go have a little fencing business on the side, and then you're going to write all your medical expenses through that. Well, they don't allow you to, because you're not really truly being a business owner. That's a side job. So when you're a sole proprietor, they put a little bit of restrictions on that. You have to be, this is your main source of income. And then they limit you to how much you can claim. So you're allowed per person $1,500. If you have a spouse, you can add another $1,500 to make it a $3,000 family limit. If you have children under 18, for each child, you add $750. If you have children over 18, for each child living with you still, you can add another $1,500 for each of those children. So you can end up having a family limit of, $3,750 if there's like a mom, dad, and one kid under 18, which is a lot of money that you can put as a sole proprietor, and that you are not going to pay income tax on your medical expenses for that amount. So that's kind of
the system actually converts a taxable income into a non-taxable benefit, right?
Correct.
Through
Correct.
yeah.
Because when you are a sole proprietor or a business owner, an incorporated business owner, you have to go out and make that money to cover your medical expenses. Then you have to pay tax on that money, and then you have to net back to net out how much you need for your medical expenses. Where this program takes away that having to add the amount of income tax that you need to actually afford your medical expenses. So you're saving that income tax. Kind of more complicated way that I explained it, but long and the short of it is you end up saving significant amounts of income tax that you have to pay.
Sure.
So as an incorporated business owner, it's a little bit easier because you don't have to have those hurdles that you have to jump through to qualify. Once you're incorporated, you qualify, and then there is no annual limits placed. So you don't, you can have, if you're a single person, you have $5,000 worth of medical expenses, that's acceptable. Whereas if you were a sole proprietor, you would be limited to that $1,500. So those are the two differences that we deal with.
So there is no limits when you're incorporated at all?
No, not really. I should qualify that. There's a limit of reasonableness. So if you are, it's like with any other, you have to look at it like a business expense now. It's like any other business expense. It has to be reasonable to the business that you run and the position that you're in and the income that you're making from it. So if you're just making $100 worth of income, but for some reason you're going to try to expense $20,000 worth of medical receipts, CRA may look at that and say, well, like, are you really in business? Or are you just trying to get a write-off of your medical expenses kind of thing? But we don't really see that. That's generally, I've never really come across an issue like that in the 24 years I've been working. But you do have to have that. That is in the income tax rules. There has to be reasonableness.
Yeah, for sure. Okay, I had a client that we sent to you, and they had a very unique situation. They were in a very medically difficult situation. They needed to get I think an operation on their back, like a fusion of discs or something like that. And they actually flew to, I think, Germany.
Mm-hmm.
Came back, and the expense of the operation as well, the flight back and forth, is that considered excessive? And what are the issues on that situation?
It isn't, because that is what I'm going to say is an unforeseeable expense. So now it becomes an allowable medical expense. There is a little bit of an issue with people who come across those kinds of expenses and then start to look around for how they can write this off as on their income taxes or something, and they apply to us. Technically, you should be opening up an account with a company like Corporate Care early in your years, so that if something unforeseen like a huge medical expense comes up, CRA won't look at it as, oh, you're just doing this for the opportunity because it just arose now. There has to be kind of a bit of a an insurance mode to it, where it's sort of like when you buy fire insurance for your house, that you're buying it. You can't buy it when your house is on fire.
Yeah.
You have to sort of be in the program, and so it's good to sort of like it doesn't cost anything with our program to sign up or set it up or anything. But once you're in there, and if you've been in there for a couple of years and then something comes up, well, you've got that as a backup to be
Sure.
able to use those expenses.
Yeah, that's it is an amazing, it's a little bit of an astounding kind of a thing. When I was first researching it, and I realized that, hey, I can sign up for this, but it doesn't cost me anything to sign up. And if I don't use it for 1, 2, 3, 5, there is no cost on an annual basis. The cost only comes when you're actually using the system at a nominal cost, in my opinion. But there's not very many programs that don't have some sort of a sign-up cost.
Right.
I know there are competitors that you operate. They do have a sign-up cost, and I don't know if they have annual fees. Maybe some other ones do or so. But I'm always looking for the cost and always saying, okay, listen, because the probability of medical, that goes up and down. I mean, you can have 3-5 years of nothing, and then all of a sudden huge, and then all over the place.
Correct. And we purposely do that because, like, I truly believe that every business owner should be in this kind of a program. So we don't want to set up a hurdle for you not to get in, and because you don't quite understand it. A lot of people don't understand it. We don't want to set up like, oh, why would I pay this fee when I don't know if I'm going to get anything out of it. So we purposely set it up so that the entry is free and easy. It's pretty easy to sign up for with our program. And then you can give it a little try. It doesn't cost you a lot to even give it, like send in $100 worth of medical expenses, see how the process works. But truly, I truly honestly believe that every business owner should have a program like this, even if you have a program through a regular life insurance provider where you're paying those monthly premiums. They don't cover everything. Eyeglasses only once every 2 years, all this kind of stuff. And eyeglasses are a significant expense that you could be writing off through this program. So you can use this as a top-up program. You can use this as an executive bonus program, or you can just use it full on like you guys do. It's a great cost-effective program, allows the flexible benefits for your employees. They can use their health spending account on whatever their family needs, not that you're locked into only this amount of teeth cleaning or no orthodontics or whatever. You can just spend it on what your family needs are.
Yeah. It's a great program. It was a little bit of a sell for my employees because everybody the mindset of the average Canadian is, well, okay, what's my dental plan? What's my group insurance and stuff? They go, what are all the stuff that we and all of a sudden here I come up with this thing and says, no, you get X amount of in our plan. The longer you work with us, the higher per month that we put into a savings plan, and it after a certain amount, it starts going and it accumulates in there. It's like a little savings plan. And so they save it. And I've had employees for 3, 4, 5 years, and they've got several $1,000s in there. All of a sudden, what was the one thing that, oh yeah, one person went for laser vision, like for and that is like $4,000 or $5,000, or if I remember, I don't even remember what it was.
That would be about right. Yeah.
But it's, and there's no way that they would have been able to do it. And first of all, with any other system that's out there that I know of. And second of all, basically, they got it tax-free. Actually, they got it tax-free. Is it tax-free? Like, for instance,
yes.
Like they would, let's say they spent $4,000 and they got a $4,000 receipt. They hand it into our company. And our company then sends the funds to you, and then you reimburse $4,000 to the employee. Right. So they basically converted an after-tax expense, and now they get paid in after-tax. Do they have to claim that as a taxable benefit?
No.
No.
It's a complete tax-free benefit. Yeah.
Perfect. And so it's a benefit for them, and it's basically it's about 95% of the actual cost is a true benefit. If I took when I did the research on these other group insurance and stuff like this, the national average for every dollar that an employer or an employee puts into a plan, they're able to pull out 60 cents. That's the national average in those things. And I'm going, goodness sakes, you're putting in $1 and it only benefits my employee 60 cents. That was a bad ROI on there. I want something higher. So with this, with the corporate care, you're looking at, well, 90 cents in that area, or 90, slightly more than 90.
Yeah, it would be more than 90 because we have a charge of the 5% administration fee. So
okay. Yeah, so it's about 90, 95, 94, 96, something like that. Yeah, in there. So it's a great return. And it was a little bit of a sell when I first mentioned it to my employees. But after a couple of years, all of a sudden, they realized the real benefit of it. And it is very, very encouraging. I don't think, like, no one has ever mentioned anything about group insurance ever since, because they all, like, the employees talk to each other and they say, man, you have the freedom to do whatever you want with it, and you don't have to worry about, getting this charge and that charge and then getting paid back, and then all the different things. With group insurance, I haven't used it in like 20 years or whatever, but you have to go through a plan. Like, if there's one thing, and this happened just a little while ago to a friend of mine, prior to this medical plan that just came out, what was it, 2023, that the Liberal NDP came out with or whatever. The medical expenses, like to get a cleaning was, let's say it was $1. And now it was now like $1.80 or something like that. And the cost just took off. And so there were some people going, like, the entire industry just gave themselves a huge raise because of it. And so there was a lot of people really ticked off. And sometimes when you go and get a cleaning or you get something done, they will say, do you have a medical expense? And your rates are different based on whether you have a medical expense. So how much are you actually saving sometimes? Yes, I'm going to get a little bit, but you have to pay a much higher rate for it too. And I'm not a big fan of that, of two different invoicing systems out there and rates that are out there.
I think technically they're not allowed to do that, but I've heard that practice being put in place. But
they don't. Yeah, it's absolutely, they don't. Nobody publicizes it,
right?
But I know, because if you say no, you get one rate, and then you actually don't see what the other dollar figure sometimes even is if you do have an insurance policy. So, but anyway, that's my 2 cents worth in there. What are some of the situations that you've been involved with in your 20 some odd years doing this?
Well, I guess some of the like you say, the bigger ones where people have to fly somewhere to Europe, or mostly they go to Europe to get a procedure done. So they have those ones are a little bit more involved, because you can write off your travel expenses for those, your airline fees, your hotel, your food while you're there. There's some rules and regulations around that. So it's great because a lot of people will phone ahead and say, what's up? What can we do? So they want to stay in the rules, in the lane. Yeah, I think, we just have a lot of people that will come across some unusual circumstances. And so they'll email us and say, hey, can I expense this or that? And, we have a couple of clients that have CNI dogs. So their food expenses for their CNI dogs can be written off as a medical expense.
Wow.
people who have cancer, you know, that who get wigs, the cost of a wig can be written off. Yeah, there's just I recently been for a few years now, but medical marijuana, medical cannabis is now an allowable medical expense through CRA. Just to go through some things that people always miss that I'd like to point out is that if you are a business owner, but your spouse works somewhere and has a plan, their monthly premiums are a medical expense. So you can take the monthly premiums that their spouse is paying and put them through your business to get a tax refund essentially on those things.
And whatever is not covered by that.
On top of that, you can put through the corporate care. All dental procedures are covered except for teeth whitening. So, you know, braces, all that stuff, not to any maximums. You can to the maximum that your employer gives you, or if you're a business owner, you know, you don't have a maximum, you can write off orthodontics. The LASIK eye surgery, big ones, glasses, contact lenses, ambulance services. If you have to pay for an ambulance, you can write it off as a business expense. Diapers for adults. More and more of that as people get older. It's a medical expense. Hearing aids, orthopedic shoes, boots, inserts with a prescription. Those are allowable medical expenses. There's actually on CRA's website, they have pages and pages and pages of medical expenses that are allowed. So we sort of touch upon like the ones that are normally covered, but there's always ones that you don't know what family is in what circumstance that they're missing out on something by kind of not reviewing that. It's pretty hard to talk about them all because literally it's hundreds. And I always suggest that people sort of review them, the list of them, because they're, you know, for you, you know what your expenses are, what possibly you're missing out on claiming, either for the medical tax credit or putting through a plan like corporate care.
Okay. If say a corporation has more than one employee, like say 4, 5, 6 employees or something like that, do they all have to be included, or can you exclude some employees, and what are the rules associated with that?
Yeah, so a little bit that falls under the labor laws too, that you do have to treat employees in classes the same. So if you designate classes in your company for, you know, there's a management level or administration level, and I don't know what other kind of level there would be, but if you put them in classes like that, then you can differentiate between classes. So you can just say, you know, this is just a benefit for the management level, or you can have different levels of, you know, administration gets X amount per year, you know, shop floor people get X amount per year. So you can create divisions, but within those divisions, you have to give everyone the same.
Everyone the same. Okay.
So that what the divisions can also be how many years you've worked.
Yes, like our plan works. It is, I guess you would say though, we used to do it, we'd set everything all up by a spreadsheet, and we would just, it's not that bad. If you only have, you know, like we have, you know, 25, 35 employees. Yeah, okay, we can run it through a spreadsheet. I suppose if it's really, really large, then you should probably incorporate something a little bit bigger, maybe.
Yeah, with the larger companies, typically what happens is that they leave funds on trust with us. And so they don't do any administration. The employees actually go online and send in their own claims. And we pay out based on the information that we have and the limits that were set. So when you get to be a really large company, you're doing less administration. But then you're leaving those funds on deposit with us so that we're not emailing you every day saying, so put a claim in, pay us. And we operate that way with a number of companies too, where employees just direct contact us. We email the invoice to the company, they pay it, and then we pay the employee. So it a little bit reduces their administration.
Sure. So let's explain exactly what happens. Because there will be a little bit. I've had some clients say, "Yeah, I really want to do this," and then all of a sudden they realize what their responsibility is, and they go, no, it's too much work or something like that. But let's explain it so that people understand the impact on it on there. Let's say, for instance, I have eyeglasses and it's $1,000 invoice. And so I went out, I got them, I have my $1,000 receipt here. What do I actually do? Let's say I now have to, I guess, submit it to the company. Let's say that's the way our company does it. So I submit it to the company. Then what occurs?
So then a claim form is done up on our website, which is pretty simplified because what we're just doing is collecting the name of the company, the name of the employee who should be refunded, what the amount of the expense or expenses are, what kind of expenses are. And a company has a choice of then hitting the submit button and mailing us the supporting medical expenses, or the employee, it works the same way. Or there is a way to scan and upload those expenses into the claim form if you have a scanner, or if you actually open up the program on your cell phone, you can snap a picture with your cell phone and it uploads it immediately. You hit the submit button and everything comes into us. Okay. At that point, we're reviewing the claim summary. If the receipts weren't uploaded, we wait for them to come in the mail. Once we get the claim from the company or the employee, we review everything. We make sure that the medical expenses qualify. We then invoice the company to cover the medical expenses plus our fees, which is a 5% fee and a $10 handling charge. As soon as we receive those funds, whether it be by check or by e-transfer, we process the refund to the employee, and we refund the employees by one of two ways. We can mail you a check, or we can direct deposit to your bank account. We like direct deposit because you get your money faster. But we don't like, so from the time we get the funds from the company to the time that we process the refund, there's very little time in between, so that the process works very quickly. The process sometimes, the extra days that are added on is if things are being mailed to us. If we're using our online process, it goes a lot faster, but if we're waiting for mail to come in and then checks to be mailed back, it lengthens the process a bit, but not that much.
When it comes to medical receipts, do you keep digital copies, or do you keep originals, or what is the rules regarding that?
We don't keep originals. We do keep the digital copies. So if you use our digital claim process, we get digital copies. We do retain those for a couple of years for you, but it's up to you to keep your paper copies for the 7 years, just in case CRA decides to audit. But we do keep backups for a while, digital backups. If we receive them in the mail, we return them. We scan them and return them to you.
Okay. Okay. So I know there was a similar non-taxable benefit court case actually in Quebec, having to do with non-taxable benefits and meal allowances and stuff like this, where somebody claimed non-taxable benefits and also the TL2. Once a person goes through the process, hands in the receipt to you, let's say it's digital, they can't turn around and take that same receipt and do it through the personal income tax system as well. That's double dipping, right?
Correct. That's
just to clarify that, because there's some people going, I can do do both or something like that. Right. That would be classified as double dipping.
Yeah, sure. Definitely.
In there. So all right, so you're based out of Manitoba, and you have, I'm assuming you have clients coast to coast.
We do.
Yeah.
Most of our clients are in Western Canada, but we do have and Ontario, but we do have clients out east too. Yes, further east. Sure.
Okay. Okay. Now what I'd like to do, and I consider this to be fun, but there's not very many people who would think this kind of detail in income tax is actually fun. What we're going to do is to take a look at a single person living in Ontario and seeing what kind of return on investment they get when it comes to handing in medical receipts. Now, in order to get this type of information, I actually had to have a staff member do actually thousands of personal income tax returns in order to find out under which category, which earnings as well as volume of medical receipts, what kind of ROI an individual gets. I'll explain the chart for the viewers. Across the top, we have different rates of income, starting at 12,000, then 20,000, 25,000, 30, 35, 40, 45, all the way to $100,000 in taxable income in Ontario. There's a green block, which is between 55 and 70,000, and that represents the average truck driver in Canada and what their T4 earnings are. So that's approximately where the average driver has. Now, on the left-hand side, starting at $100 worth of medical expenses, then $500, then $1,000, $1,500, $2,000, and then it goes up $500 all the way up to $15,000 worth of medical expenses. And so you have this grid that's out there. Now, in order to get, let's say if let's say $3,000 worth of medical expenses, and you're making $60,000 in taxable income, and you take that $3,000 worth of medical expenses and you hand it into the person, the person who does your personal income tax return, what kind of a return on investment would that be? $3,000 times, in this case, it's 0.0811. That's $243.30 an individual would get back based on $60,000 worth of taxable income and $3,000 worth of medical expense. $3,000 is actually a little bit high nationally. I kind of expect the average Canadian. Do you know what the average Canadian medical expenses that would qualify, what they would actually be?
I don't, just going by what we get in through corporate care, I would actually say for a family, you are looking at between $3,000 and $5,000 is average
Per year.
per year. Yeah. Because when you've got family, you're looking at glasses, you're looking at braces, and then there are a significant amount of people that have certain drugs that they have to take, diabetics or whatever. So yeah, there's but now if you go down to what I'm going to say single people, you are looking probably a little bit more closer to like the $1,000, $2,000 level.
Yeah, that's what I would kind of expect so too. I know an awful lot of personal income tax prepared individuals, guys in the basement or in strip malls or whatever. And the general, there's two kind of things. The average truck driver who goes to somebody to do their tax preparation, and they call ahead of time and they say, should I bring medical expenses? There's two replies. One is, I call it a very desperate for a new client type of a response. Oh yes, we use everything. Yeah, we'll just bring it in and we will put that in there for you. And then you get the other guy who is a little bit more honest. And he says, how much is it? And he says, oh, it's about $1,000. And if it's a regular T4, don't bother bringing it in. It's not going to make any difference at all. So one is truthful and one is not.
Right. And that's exactly correct, because your first, as we discussed earlier, the first 3% of your net income amount of medical expenses don't qualify for that medical tax credit. So if you're at a $60,000 income level, that's about $1,700. So if your medical expenses aren't over $1,700, it's not going to get you anything. No use submitting them.
Yeah, that's why
But
I know.
yeah.
So a lot of it comes down to the marketing of the tax preparer. And he says, "Oh yeah, we use every month, but every penny." But realistically, it makes zero difference. But the understanding in the mind of the individual is, "Hey, this guy really knows what he's doing, and yes, he's going to use it for me." But realistically,
Right.
they punch it into the income tax form, and you can't lie on it.
Right.
It's
Yes.
all digital in there in that regard. So what this chart actually does is it shows the return on investment for all of these different dollar figures and different earnings factors in it. And what I've done is I've color coded the different ROIs and pointed out the highest ROI. So if you're a single person living in Ontario and you're making $25,000 a year and you got $6,000 worth of medical expenses, you get a 35.03% return on that investment, or somewhere around $2,000, a little bit over $2,000. So every single tiny square, or what do they call that, field in this spreadsheet represents one personal income tax form that was calculated. So we got I don't know, probably close to 500 personal income tax returns just on this one form. Now, the color coding, the blue is the lower fields, and then you have the lighter ones on the outside, and then it goes darker, and then it focuses in on in this particular example, the 25 and 6,000 is 35, and it's unusual to take a look at that. You can look at it and say, okay, the general understanding of the average individual, the more money you make, the less your deductions would be. That's the thought, that the more money you make, the less your deductions are going to be able to be utilized. The other factor is the more your deductions are, the more impact or the return on investment you should be able to get. That's the general understanding. But that's not what this chart actually shows. Give you an example. If you're making $25,000 and you have $6,000 worth of medical expenses, you're making 35% return. But if you have $15,000, so almost 2/3 of your income is medical expenses, you only get 16.47%. It's a bizarre reaction there that sort of defies common sense and what you would think of in terms of what actually benefits the Canadian citizen. You sort of have to judge. And so what this really means is, if you have medical expenses of $15,000, can you split them up into different years? Yes. Is that something that you maybe go back to corporate care? Can you do that?
Well, you can first of all, with corporate care, you can put through the whole 15,000 and get more return than what's shown on the sheet.
Absolutely, yes.
But you can, so you're with your income tax return, you're picking your 12-month period that you can use. So it doesn't have to go January to December. So like if all of those medical expenses were, in November or something, you might go November to November, so that you can you can split it that way, where you're carrying forward some of your medical expenses from one year to another year.
Okay.
You can also carry forward from 1 year to another year too.
Okay.
So you can carry forward for a year some of your medical expenses. So you do get a little bit more of a return. But one of the things that, like, your chart is showing, which is a fantastic chart, like the amount of work that went into it is amazing, is that it is the medical tax credit is a non-refundable tax credit, meaning that, like, it only reduces your income tax to zero. So if you have that $15,000 and you're in that $25,000 income bracket, your taxes on $25,000 are going to be X amount, and you can only go up to that X amount of tax dollars, and then you don't get anything more back on it. And
That's that's why there's a a reducing ROI.
correct,
I see, because it's a non-refundable tax credit. Of course,
correct.
that's the impact of it. That's the three different things. It's not just how much you make, and it's not just how much your expenses are. It's also on your it could be the impact of a non-refundable tax credit. That's why it actually goes down the higher it is. That makes sense. That makes sense. I didn't even realize that. Now, as soon as you said it, I go, oh, of course. Now it makes sense on there. That one different feature. So, boy, that makes a huge difference for sure in there. So, medical expenses is you have to think it through. I like the idea, not like the idea. You have to also think of just 12 months, right? Like
Yeah.
if you're using it on your personal income tax, you can move those 12 months back and forth. I suppose to some degree, then the next year you're sort of limited to that same 12 months again.
Yeah, because you can't overlap them. But you can choose another new 12 months so long as you don't overlap your first 12 months.
Oh, yeah.
So you're a little bit locked in once you start choosing those, but it does give you the flexibility if you have a kind of a one-off large medical expense to kind of split them between 2 years that way too. So.
Oh yeah, that's good. I know medical expenses is not a very consistent thing. It's high, low, high, low, high, low, and in order to choose a response, how am I going to deal with medical expenses in Canada? You either, if you do it your personal income tax, there's a lot of different factors. You have to do timing issues. There's a lot of different things you have to all consider. But when you use corporate care, now it's a very secure answer that you're getting.
Right. And we're vetting the medical expenses at the same time because a lot of people misunderstand what you can. There are a couple of things that are not considered medical expenses that will blow up your tax return. And one of them is using any expenses that are for over-the-counter medications, meaning aspirins, Tylenols, antacids, laxatives, decongestants. All those things don't qualify because you can just walk into a store and buy it off the shelf. But people, for right reasons too, they're medically for medical reasons, but CRA doesn't recognize that as a medical expense. So if you submit $6,000 of medical expenses, there's a really good likelihood that you will be audited.
Yes.
And then if you have any of those in there, they don't like that. And then they think that you're trying to cheat the system a little bit, even though it might just be a small amount or whatever. You're going to always be audited because you're kind of on the blacklist of sending in wrong medical receipts. So we adjudicate those things and we throw out things that aren't allowed to keep you on side. Now, a little funny little trick with the private health service plan side, which is what corporate care is that CRA allows a kind of a 10% leeway of expenses that like if you put through one bill for aspirin or something, well, it doesn't necessarily have to be kicked out so long as it's not more than 10% of the claim that you sent in for the year. So there's a little bit more leeway with this plan because we are adjudicating all of the claims and everything. Whereas with your, if you send it in personally, and you got one thing in there they don't like, you get on the bad side.
I have some friends, a lot of friends who do personal income tax returns, and they actually maybe I use the word despise medical expenses.
Yes,
is because if you have something that's more than $1,500, $2,000, they say it's universal, almost always flags for an audit. And it's always a problem later on. And so if they have a client that brings something in that's too high, they have to either bill more because they know there's going to be an audit, or they're going to have to say, okay, under audit, you're on your own kind of a thing.
right.
it's a sticky situation. It's not as clean
No.
as say, for instance, corporate care. Corporate care, you have more flexibility by far, and it's a lot more consistent, a lot more efficient, for sure in that regards when it comes to savings in there. So
What I would say with well, I'm going to say with both programs, but with a personal, if you're going to go, if you're just submitting personally because you're an employee, um, through the income tax portion, is that you get yourself a nice little brown envelope like this, mark the year 2024 on it, and then you just systematically throw all of your receipts in there through the year so that they're just in one place and you've kept them all. Another little trick too is that you can go to your pharmacist at the end of the year and ask them to print out a listing of all the drugs that you ordered through the year. And you can do the same thing with your chiropractor. You can do the same thing with your massage therapist, so that you just have one listing of and a total of all of your medical expenses, as opposed to all these little receipts and stuff. Then it becomes a lot easier for the income tax preparer to like look at them, because you can have 100 drug receipts just on one piece of paper with one total, and they're more apt to include that in your income tax return because it saves them a whole lot of work.
Yeah.
And same thing goes with corporate care. We like those, recap sheets. They're great. And then you haven't lost a receipt. You're making sure you've got all your medical expenses all in one place.
yeah. Oh, that's amazing. I'm a big believer in digital, and we've been digital in our company since 2019. And so when COVID came in, nothing really changed for us at all. Actually, more people went digital, and CRA is actually pretty reasonable when it comes to digital. We've had any problems at all with stuff. And so that's a little bit of a historical back thought of a lot of people. Oh yeah, they're going to disallow it just because it's digital. CRA has actually been quite well tuned up to the digital world, which is, from an administrative perspective, that's probably one of the best areas that they perform in. The rest of it is kind of, oh, okay, whatever, but anyway, that's fascinating. Let's maybe go through some of the things that are allowed that a lot of people don't think that are allowed. We don't have to go through the full list, but some things that I'm sure you got asked a question: can you use this? And the general understanding is no, you can't. Like you mentioned, for instance, chiropractor or some therapy, or are there what do they call it? Therapy, counseling.
Yeah.
What is allowed and what's not allowed?
Yeah, so counseling services or treatments are allowed. They have to be done by qualified medical practitioners, so social workers, psychologists, psychiatrists. If you're using those services, those are an allowable medical expense. And I'm glad that you brought that up, because there is, I've seen personally in my business, a huge uptick in those services in the past couple of years. So yes, feel free to use those as medical expenses, because it's a qualified medical expense.
But you have to be qualified. What does that mean?
So that just means that it has to be done by someone that is recognized as a medical practitioner. So if somebody sets up an office just to what I'm going to say is do life coaching, but they have no credentials to do that, but they're just, hey, and nothing wrong with those people. They actually do nice service for people, but that's not considered a medical expense. CRA wants it to be allows that to be a qualified medical expense if it came from someone that has credentials to do counseling. So once again, social workers.
That's generally, well, it could be a social worker, but it's generally, if it's a private counseling, it's generally a master's degree, right? Or not?
Yeah, they have to have some kind of qualifications that, like, so we do, we will, when we don't recognize companies, we will search it out to see, because we do get occasionally companies that are out there that provide health benefits that aren't qualified. And not to say that they don't give you any health benefits, but CRA limits what you can expense to certain qualifications. And so off the top of my head, I do, there's just some procedures that go on sometimes that may or may not help people, but CRA won't allow them as a medical expense because the person performing it has no medical background. They've just set themselves up to provide, like sometimes they're just issuing vitamins and supplements and which those things in themselves aren't allowed as a medical expense. But if you're going to a naturopath, the services of a naturopath are an allowable medical expense, but not the supplements that they prescribe, even if they're prescribing them.
Okay, but they have to be a certified naturopath?
Yes, yes.
Okay,
Yeah.
because I'm just actually interesting. 2 days ago, I had a guy in my office. He's a truck driver, and he was getting into life coaching, which is quite popular nowadays.
Yeah.
And some of the it's amazing. Some of the people who are coaching, some of their they have zero qualifications, and sometimes their life is in absolute shambles, unfortunately. But there are places, especially in the States, where they it's sort of a multi-level marketing scheme, and we certify life coaches. Okay.
Right.
And it's a self-certification basically through a corporation. It would make it and it makes it look official when in reality, no, it's just self-certification. I can self-certify dog walking if I want
Right.
and have a Robert Scaper dog walking certification, and who cares? Anybody can do anything
Right.
along that lines.
And nothing to say that the services that someone might provide under those is good or isn't good, but CRA just doesn't recognize it as a qualified medical expense.
Yeah, fascinating. All right. Okay, now let's move a little bit further down from a single person living in Ontario and see what the impact happens when you are a family in Ontario. The next thing, and there is a significant change in the ROI and where the point of highest return is on that. Now, in a family situation, $40,000 and $6,500 gives a 28.47%. And again, this has some things to do with again what you stated, the
non-refundable.
Okay.
Tax.
What happens when it is 12,000 and 20,000? It seems like it went like at 40,000 it's 23, and then it goes down to 30 at 30,000 for the same thing, and then it goes down to 19, and then the lower the dollar figure, it actually goes back up to 23 again. Unusual features in there. What impact does non-refundable tax credit have in that, or can you figure out why you get weird results like that? It's maybe not a huge factor. It just goes a few percentage difference.
Yeah, not exactly off the top of my head why it makes those little deviations, but it would have to do with the non-refundable tax, with the child tax credits that impact into those numbers, but they generally follow the pattern that as you have higher and higher expenses on a certain income level, that you have diminishing returns.
Yeah, for sure. Now the average or say somewhere in the peak in the family situation here, you got 28% return, but the vast majority is somewhere around the 15-20% return. If you flip that into corporate care, in a family situation, your taxable income, what's the tax rate? I guess the ROI on that has to do with the tax rate of the province, as well, both the federal and provincial tax rates combined. And that's what creates this return on investment as well, right?
Correct.
And so when you put it through the corporate care, you're getting the maximum benefit in each category, like
Correct.
at each employment record. So just the natural mathematical benefits lean towards corporate care, and
Significantly.
yeah, exactly. And so realistically, when it comes to making that choice, should I put it personally or should I put it through corporate care? The leaning is always towards corporate care, always towards corporate. The benefits. And unless you want to sit down with a piece of pencil and go through each and every single year and try and save that extra $1.47 or something like that, you might get some sort of a difference. But generally speaking, medical expenses is something that you don't put a whole lot of mental effort into it. Like you said, you put it into a manila envelope, and at the end of the year, you total it and you just deal with it one shot, and then you move on with your life because there's other things that tend to be more important. And that's why I said when you're making the decision, how do you use your medical receipts, either through your personal income tax return or through, for instance, corporate care, the leanings of the benefits tend to always outweigh when you're using corporate care rather than the personal income tax return.
And I'm going to say that, like, as your income increases, it becomes more and more advantageous because it's directly tied to that income tax rate.
Yes.
So in this case,
well, the income tax rate as well as that 3% of
correct.
as well.
Yeah.
And it just exacerbates the whole problem. So there's this pull towards it, and the reverse is true too. You get a higher benefit the more you make, and so you better be using the corporate care in that regards. It's fairly straightforward. We're dealing with truck drivers basically, and truck drivers like, just give me the bottom line kind of a thing, And you say, you know what, bottom line, corporate care. That's where I put you. And generally, okay, there's another thing too. Can you accumulate? How much invoices can you accumulate? Can you do it over multiple years in corporate care?
No, because it's like a business expense. So you have to match your business expenses with your business year. So it's like any other expense. For a truck driver, I don't know, if like fuel expenses or something, you match it to the year that you're driving your truck in. So it matches exactly year to year. So if your fiscal year is January to December, then January to December 2024 is just shortly after December, you can submit them to us. We'll process it for you. And then you've got your document to give to your accountant to include in your 2024 business expenses.
I see. Okay. That's very good. So it goes with the business cycle of the
because technically what you're doing is turning your personal medical expenses into a business expense. Yeah. So you're reducing your corporate tax that way too, but you're also, same thing at the same time, drawing out of your company a tax-free draw of whatever your total medical expenses, say $1,500. You're getting a tax-free draw out of your company that you don't have to pay tax on, and that typically will generate you a almost $300 to $400 tax savings by doing that. Yeah. So those two things happen at once. It's kind of a double tax because we never really focus on the tax savings on the corporate side if you're a corporation. So there is a little bit of a double tax benefit.
When it comes to utilizing corporate care, I've explained it to truck drivers several times, and unfortunately, there are people who say, "Oh, I know what I'm doing there, and I'll just submit my medical expenses to my corporation, and then we'll just write it off as an expense." And it's a gross misunderstanding of what the system actually is. It has to go through, what do they call?
A third party,
Yeah.
administrator, which can be an insurance company, or it can be like corporate care, which is what we are. We're a third party administrator, because what we do is look at the medical expenses and adjudicate them for you. And it's like creating expenses for yourself. You can't create your own expenses and run them through your business. You kind of need a third party, arm's length.
When it comes to liability, if CRA ever audits, who is liable for that?
That's a good question. We've never really run into anything, but we adjudicate the medical receipts, and so from our perspective,
So when Canada Revenue Agency looks at the paperwork, and they say, okay, corporate care did this, they know the rules, so be it. But if a third party would just say, hey, you know what, I'm going to be a third party so-and-so, and they say, okay, I'm going to write everything off through there, okay, they have to know the rules.
Yes.
For sure. You can't just, write off anything
Correct.
Through there. So is it a regulated industry? It is obviously regulated because you have to follow the rules.
Yes.
For that. But that is how do I say? I know enough people in the trucking industry, they love the shortcuts because they don't want to send somebody, like if it's one driver drives it themselves, they paid $1,000 for their sunglasses, and their eyeglasses, and then they have to send $1,050 or $1,060 to somebody else only to get back $1,000 back again. Well, they say, well, I'll find a shortcut for that. I have to come up with $2,000 now as opposed to only $1,000, and they don't like that. There's some guys who are their cash flow is so tight.
Yeah.
Can't afford stuff like that.
Right.
And that it is a little bit of a management issue, but unless you actually follow the rules, you're really not going to be able to glean the benefits of it.
Well, and it depends on what tax bracket you are in, and how much of your medical expenses are, because you are leaving hundreds of dollars on the table by not sort of going through the process. And I do understand about the tax flow, the cash flow, because we do, that's why we try to turn around the refunds as fast as possible, because every business owner, like if you got $5,000 in medical expense and you're sending us $5,000 plus our fees, you're out that $5,000 for your business kind of thing. So you want to get that return done as quickly as possible. One of the things that we do offer is that you can pay by credit card. So we do charge a credit card processing fee on top of it, but that way you're paying us with your credit card, and then you're getting your refund, and then you're not out the cash flow, because when you get your refund, you pay off your credit card. Yeah. So it's a little bit of a trick that you can do if the cash flow situation is and it is an issue for lots of people. Yeah. The other way is that you just remit them the same way, like you remit your expenses more often, but you pay for your medical expenses with your credit card, and then you're remitting and you're getting your refund and then paying off your credit card with it. But that gets a little bit more, a lot more administrative work, where you do it.
I try to do as few transactions as possible I try and keep it as simple as possible. That's for sure. But not everybody is like that. That can be.
We're always looking for ways to make it easier. So if anybody out there ever comes up with an idea that makes it work a little bit more smoothly for them, we're open to working with them to make it work for them, because that's the whole part of it, right? Let's get as much tax benefits as we can. So let's find ways to do it together.
Sure. Well, that is great. That is great. Thank you very much. Boy, I really appreciate this this time together. I don't know if I've ever exhausted a one particular topic as much as this particular one. I'm really grateful to understand this, because I keep getting asked an awful lot as an accountant, how do you deal with this? How do you deal with this? And I want to deal with this once, and I say, okay, go to the podcast, go do this, and this is how you deal with it. So it's a great topic. I've actually learned a lot. I didn't know anything about like self-employed individuals can utilize the same thing with other restrictions, of course, but it's a very unknown industry in Canada.
It is.
And I'm really glad that I stumbled across you a number of years ago, and then utilizing it, because I want to get the highest value, not just for my business and my employees who get great value on it, but clients as well, because everything can go totally smoothly, and then all of a sudden they get some tsunami of medical, well, how do I deal with this? And the greatest platform is just great. Now you use it like this, and then you go back hopefully to a level medical situation for sure. But taxes, my whole life seems to be focused on reducing taxes.
Yeah.
Because I think Canada is a grossly overtaxed environment. And if we don't do something about it sooner or later, I personally believe that Canada has been in sort of an intensified and a less intensified tax revolt probably since the 80s, where they raise taxes, people yell and scream, and they bring it down. Then they raise it and they bring it down, and they find different ways of doing it. And Canadians are getting a little bit tired of this up and down, and we're sort of like breathing through a straw kind of a thing. And this is a great option for a lot of people who are doing it.
Hey, this is a big freebie, because you have to pay for your medical expenses. No ifs, ands, or buts about it. So why leave the tax benefit on the table? Costs you nothing to sign up. And then there's that 5% administration fee, but it's getting you back hundreds of dollars. And yeah, if you're in that, I'm going to say $50,000 income range, and you've got $1,500 on of medical expenses, close to $400 back in your pocket. That's there. Like, the government has all of these little offerings for you to take advantage to help ease that tax burden. Might as well use it. And yeah, it's a little bit like, it's very easy to sign up on our website, e-benefits.ca. No, doesn't cost you anything. Just get going on it, and hopefully you use it one day and save yourself some tax money.
I know. Well, Margaret, I'm thrilled to have spent this time with you, and I'm grateful that we had a great conversation like this. And I hope I hope as many people as possible just flood your business, and we get more and more Canadians saving some of those tax dollars.
Yeah, and you know what? I look forward to maybe setting up a special platform just for truck drivers or something to make it as easy as possible for them. I would love to do that, but thank you so much for the conversation and your interest. I think it's fantastic how you try to help people with their taxes like this. And this chart is mind-blowing. How you guys put together this chart to show what the medical tax credit does for you is fantastic. So
Right
good
on.
on you guys.
All right. Thank you very much. And we'll talk to you some other time. Okay.
Perfect. Thanks, Robert. Take care.
We discussed the return on investment of personal income, medical expenses in personal income tax return with Margaret on Ontario, in Ontario as a single individual as well as a family situation, and the effects that has. Now we're gonna one by one go through each individual province and show the differences between the effect of medical expenses in different provinces. And it's fascinating. the amount of personal income tax returns, first of all, for to do these charts, for all provinces and territories, we think we have to do somewhere around 12,000 personal income tax returns, which is an awful lot. But hopefully, I think we only have to do this once. Even if sometimes taxes change a little bit, it shouldn't materially change what the net effect has on personal income tax that much. The principle is the same. So first of all, let's go through individual provinces here. Let's take a look at the single person living in BC, the return on investment. Once again, you see the exact same chart with a little bit different return on investments. For instance, the best in BC is actually $25,000 income with $6,000 in medical receipts, which would be a 38.8% return on your investment. If you compare that to Ontario, 25 and 6, it's actually identical. The best return on the investment is both, but Ontario is 35.03 and British Columbia is 38.8. Actually, all of the red in British Columbia is higher than the highest one in Ontario. So you get a little bit better ROI in British Columbia with medical receipts than you, of course, you do in Ontario. But again, you see the differences. The blue is ranges from 15 to 19, and it's the same thing, pretty much the same thing in Ontario for that. There is a slightly larger income. It goes from 45. You get a little bit more. If you get very, very high British Columbia medical receipts, you do pop into the 20% return on investment at 50. Otherwise, it's 45. And in Ontario, there's no 20% at 50. It's all less than 20% in there. Now, interestingly enough, the difference in a family living in BC again is 40 and 65, and in Ontario it is 40 and 65, identical. But Ontario is 28.47, and in BC it's 28.48. So it's virtually identical in a family in British Columbia versus a family in Ontario. Though, if you take a look at some of the higher positions, it'd be 25, 27. It tends to be a little bit higher ROI in BC, but then it drops off significantly enough. Let's see, you got 23s and 21s at 12, 23s and 20 or 22s and 23s at 12 in Ontario. Very, very minor, maybe a 1% difference, a 1 or 2% difference in family living in BC versus a family living in Ontario, the ROI in medical expenses or so. All right. So the next province that we're going to look at is actually New Brunswick ROI, and that a single person living in New Brunswick, the ROI, the highest, again, it's actually a $30,000 income for a single individual and $60,000. Excuse me. If you go in Ontario, for instance, comparing it to Ontario, it's 25,000 and 6,000, and but in New Brunswick you can make 30, And the ROI with New Brunswick, you're looking, the highest is at 6,000 again, 30,000 income. That's 40.95% return on investment. And so you're looking at 40% versus 35% in Ontario. So you do get a little bit of a difference between different provinces. You get in this particular chart, you can see that some of the 20% ROIs actually filter all the way out into the $100,000 income, and you're getting you have to submit $15,000 worth of medical receipts before you get that 20%. But this is the first province that shows higher than 20% or higher at the higher dollar figures than 50,000. So New Brunswick is a little bit different. It looks very similar in nature to Ontario, but the percentage rates generally would be about 5%, 3 to 5% higher in New Brunswick than in Ontario. That could very well be, generally speaking, could be that the income tax is higher in New Brunswick than it is in Ontario. So that would be the logical explanation for that. Family living in New Brunswick, again, these numbers are very different than Ontario. The highest ROI is 40,000 and 6,500, and 40, which the number is identical. 40,000 and 65 family in Ontario gives 28.4, and here in New Brunswick it's 32%. And so again, it's about a 3 to 5 percentage higher ROI on there. And again, it stretches out 20%. Goes off into the 85, 90, 95, 100,000 range at the 14, 15,000 medical expenses. So it's a little bit, it's different. It's interesting. And when you really get down to it, if you ever thought that there is some bureaucrat somewhere sitting and saying, okay, what kind of an ROI, what kind of refund are we going to give the Canadian citizen when they have medical expenses? And so they say, oh, how about if we try this? How about if we try that? And you get differing results on there. So it's quite significant. And the anomaly that, the higher you make, the lower you get, and the higher your medical expenses, and not necessarily the higher your ROI on there, all having to do with it being a non-refundable tax credit. That one feature that, okay, we're going to give you a medical credit, but it's going to be a non-refundable medical credit. And so they really hone down what your refund is going to be. Extreme individuals, the general rule would be then, if they're only going non-refundable classification on medical, is that the best case scenario is you don't pay taxes. You're not going to be getting money back that you haven't paid in taxes. That's the general Canadian rule. So that's what it means very specifically when it says a non-refundable tax credit, that you don't get a refund higher than what your taxes are. So let's take a look at another province. A single person living in Alberta return on investment. Once again, it looks similar in nature actually to New Brunswick. The ROI again is 30,000 income and 6,000 in expenses, gives a return on investment of 41.99. and compare that to Ontario, Ontario 35.03, we're talking 7% here difference. So Ontario is certainly not the highest ROI. At this point in time, Alberta tends to look very significantly better. Once again, you can see the 20% or higher ROI on 85, 90, 95, 100,000. And and the break even on the 20% is at 13. So you got $13,000 worth of medical receipts, and you're going to get, even if you're making $100,000 a year, you're getting 20% ROI on there. So Alberta's it's either a higher tax base, or that you get a non-refundable tax credit on, or it is just the medical expenses are being reimbursed to you, which would be the assumption then would be is Alberta has a higher tax bracket for that. Everything else is compared to Ontario. Alberta is 5 to 7% higher ROI on there, which is pretty interesting. Then again, you take a look at a family living in Alberta. Once again, it's a $40,000 income and $6,500 in medical expenses, give you 24.34%. And here's interesting scenario. Now, Ontario as a family gives 28%. That means there is a very significant difference in the formula in Alberta between a single individual and a married or a family living in Alberta. The drop is actually significant. 24% ROI is the highest in Alberta, where 28.5 is it in Ontario. If you look at it just from a logical perspective, just from a perspective of taxation, what is the reflection of a family living in Alberta has less credits, has a less tax relief than a family as a percentage in Ontario. So does the province of Alberta discriminate against a family compared to discriminate against a family in Ontario? The answer to that would be yes, by approximately 5%. What was it again? I forgot. 24.3 versus 28. Yeah, so it's good for a 4 percentage point difference. Somebody somewhere in some office is contributing to a formula that creates a disadvantage in Alberta over Ontario for a family. I don't know, somebody should answer for that, in my opinion. Now, there are some other numbers in the family in Alberta that seem to be a little bit of an anomaly. For instance, at 12,000, a very, very poor individual in Alberta tends to get a 23% ROI versus in Ontario, that is where you get almost identical. It's 23, 22 and 23 at 12. The only difference is the higher you make. So the really, really poor in Alberta, a family is treated basically the same as an Ontario family, but a family making $40,000, it's more expensive in Alberta, and so by 4%. So that's interesting to note, the reflections between different provinces. And so now let's take a look at Newfoundland Labrador. Their particular scenario, once again, is 25. It's 25,000 and 6,000. I keep forgetting what ROI Ontario is. 25 and 6,000. That's the focus on it. And there's 35%, and in Newfoundland single is 42. So yeah, 42 versus 30. So you got another 7,000 or 7,000, 7% difference between Newfoundland and Ontario. And Newfoundland gives a higher ROI for that. It's much closer in relationship to Ontario. Newfoundland is much closer in relation to Ontario than for sure Alberta, but looks very, very similar. But you got a good 7%, sometimes 8% higher ROI. Now, in Newfoundland, as a family, you get 30.9, whereas in Ontario you get 28.47. So it's a 2 or 3 percentage point difference than in Ontario. So again, there's a little bit of a difference in how a province treats their families versus a single individual. So it's a little bit better in Newfoundland than it is in Ontario, but not a significant, 2-3 percentage points. I guess that's better than nothing, but other than that, everything looks it's very similar. In Newfoundland, you don't get 20% that goes up, 85, 90, 95, 100,000. It ends at the 80,000. So there's much less there. And there's a huge jump in percentage from $35,000 family to a $40,000 family. So it again would have to do with the tax rates that are in the province, and significantly it makes a difference, but not super much, not in Newfoundland anyway. So let's take a look at Saskatchewan. And Saskatchewan, once again, the highest ROI you get for a single person living in Saskatchewan, again, is $25,000 worth of income, $6,000 worth of medical expenses, gives you 44.23. And that's what you compare to Ontario, which is 35. So realistically, there you're looking at 9% difference a single person when it comes to medical expenses. So Saskatchewan has a significant difference there already, and you have benefits for the very high earners in Saskatchewan. If you have $100,000, you're getting 20% ROI at 11,500. So the percentages in Saskatchewan are both higher at the peak, and it also gives it much higher ROI the more you make as well. So a lot bigger ROI for Saskatchewan. It looks like Saskatchewan right now is pretty much at the peak here. If you are a family in Saskatchewan, your ROI is 30.9, whereas in Ontario it's 28.5. So that's only about a 2% difference there. So they tend to give much more of a refund to a single individual than they do a married or a family situation. And again, in a family situation, Saskatchewan ROI is at $100,000 worth of income, 11,500, you're getting still 20% ROI. So that's interesting. Now let's flip to back to the East Coast and take a look at Nova Scotia. As a single person, once again, it's $25,000 in income, $6,000. It seems to be a pattern with all provinces, at least at this point. And that's 42.73. And so that's again another 7 or 8% difference between Ontario and in this case Nova Scotia. And the ROI in Nova Scotia at very high earnings, $100,000, you get 20%, somewhere around the 14,000. So that's pretty much what that it is for a single person. A family living in Nova Scotia is 31.5 or 31.52. That's at 40 and 650. And 28.5 versus what is it here? 28.5 versus 31.5. So there's about a 4% difference in Nova Scotia to Ontario. So again, the benefits are lowered down again from a family versus a single individual, but it's maybe not as an extreme a number, say a Saskatchewan or so in there. Now, Manitoba is another province that is a little bit different. Once again, at 6,000 receipts of $6,000, 25,000 in income gives 44.49 versus Ontario is 35. So here's 44.49. So you're looking at almost 10% difference between Ontario and Manitoba, which is fairly significant, 10% difference in there. Now, the other factor in Manitoba is at $100,000 in income, this is the province that has so far the lowest dollar figure that you can get 20% ROI on it, and that's $10,000. Most other provinces, a lot of other provinces, you don't get anything above $80,000 well, you get something, but it's not 20%. So Manitoba is again, it very much appears to be giving much higher return on your investment, much higher refund. And again, it could be because of the personal income tax return, of course, but that's fairly significant. Now, a family in Manitoba is quite considerable. We're looking at again 65,000 versus 40,000, and 65 and 40. You got in Ontario is 28.5, and in Manitoba, I have to scroll back and forth here, and in Manitoba is 33.16. So 28.5, about 3% difference again. Now, here's an interesting thing that's happening with Manitoba as a family. If you're making $100,000, you are getting back, I want to make sure this is $10,000 worth of medical receipts. You're getting back 20%. At $12,000 of medical expenses, it's 21 if you're making $100,000. And finally, at $15,000 worth of medical receipts, you get 22%. So it seems as a general lean, there you get much more of a medical benefit in Manitoba than you do, at least so far, the more you make, the less or the more your return is for medical expenses. So very interesting. Now let's take a look here at Quebecois. Then that Quebec is very much of an anomaly. First of all, it is 25,000, 6,000. That is the same. The amount is 32.86 as a single individual. 32.86 is actually lower than Ontario. So Quebec actually gives less of a return than Ontario does by about 3%. Now, 32.86. Now, if you take a look at the 20% ROI as a single individual, the most you can make and still get 20% is $40,000. Everyone else, you're running much higher than that. So it is very, very focused and intense. You do get something back in Quebec, but it is you have to be in that hot spot, so to speak, in order to get it. In a family situation, now this is where the anomaly goes a little bit nutsy cuckoo. The highest ROI in Quebec is actually if you get $12,000 worth of income and $5,500 worth of medical expenses, your ROI is 23.37%. If you compare that 23%, you get 28% in Ontario, and you can make as much as $40,000. So you compare 40,000 and 6,500. If you scroll down to here, I'm going to do this in Quebec. At 40,000 and 65, you get 22% return. It is a little bit of a hot spot, but there seems to be something in Quebec that phenomenally reduces the return on your investment for medical expenses. If it's 22.3 and it's 28% in Ontario, you're looking 6-7%. There's a huge difference in Quebec, both as a family as well as a single individual. So your non-refundable tax credits for medical, it's so far Quebec is the worst province, and it seems pretty much by far in there. So now let's take a look at some other places. Yukon as a single individual, 25 and 6, this is 40.64, and Ontario is 35. So you're at about 5-6% difference again in Yukon compared to Ontario. And again, you don't get 20% unless you're below, or if you're below 55,000 in the Yukon. Now, if you're a family in the Yukon, you get 29% at 40 and 650. So that it seems to be, it's very consistent that family situation is 40,000 and worth of income, $6,500. That's the peak of it, except for Quebec, which seems to be an anomaly on everything. But 29.5% versus 28.5. So it's a little bit better in Yukon as a family compared to a single individual comparatively wise. That's how they seem to treat their residents. And so let's look now at Prince Edward Island. All right, Prince Edward Island, a single individual. The key again, 25 and 60, and that's 43.62. 43.62 compared to 35. We're talking 8.5 to 9% difference. in there. There's a lot of 40s in Prince Edward Island, dips into 20,000 and 30,000, and there's even 38% at 36% at 35,000. So it tends to be a little bit better in Prince Edward Island. You're at $100,000 earnings, you do get 20% ROI at 11.5. So it tends to the Prince Edward Island tends to take medical expenses a little bit more seriously, and with a little bit more of a refund in their formulas. Now, as family as a Prince Edward Island, we have $40,000 as the basis, and $6,500 in medical expenses. The highest ROI is 32.35. 32.35 versus Ontario 28.5. So we're talking again another somewhere between 4 and 5% different for that. So that's Prince Edward Island. So now let's look at Northwest Territories. Again, it's 25,000 and 6,000. It's almost universal, except for Quebec, of course. And that's 40% or 40.2%. So there's 5% a better ROI in Northwest Territories compared to Ontario. But they cut off the 20% ROI right at the 55. So at 50,000, you get 20%. But 55,000, anything above that, you're not getting any of the 20% ROI. Now, the family, again, a little bit more, a little bit different. Yeah, actually, it's very, very similar in nature, and that is 29% different versus 29 as a family versus 28.5. So we're looking very, very close. Family in Northwest Territories almost identical to family in Ontario. Actually, it's a few percentage point difference as a single and a few percentage point difference as a family. Very, very similar Northwest Territories to Ontario. Okay. Now, we have the last province or territory, which is Nunavut. Nunavut is, again, 25 and 6, 20, there's 38.5%. That, 38.5, 35, so that's only about 3 percentage difference. And so it's very, very comparable to Ontario. And in as a family in Nunavut, it is 40 and 65, which is right now 26.5. And again, it's 28.5 in Ontario. So Nunavut is, again, very, very close to Ontario. Single is, what did I say, 28.5 and 25. So you get a little bit more in Ontario as a single individual, and a little bit less in Ontario, a little bit less in Nunavut as a family. Those numbers give you a little bit of a reflection of which province is sensitive to the medical issues of their constituents, and so you have it's a little bit yeah, I guess we could list them in terms of best to worst, but realistically it ranges no more than 10%, a 10 percentage point difference. That being said, I'm going to make one final comment about the medical expenses as it refers to return on your investment. If you're a truck driver, let's use Ontario as the basis. If you're a truck driver and you're making $55,000 to $70,000 as an owner operator. And if you have medical expenses and you use personal income tax return, you're going to get 14, anywhere from 0 to 15, 16, 17% if you have really high medical expenses. So that's the approximate range of return on investment if you use your personal income tax return. However, if you use non-taxable benefits, and the average, let's say the average truck driver, and it's an independent operator, makes $65,000 a year in taxable income. But if they use non-taxable benefits through their corporation, what they're declaring as income is actually be about between $25,000 and $30,000 worth of taxable income, maybe $35,000. Depends. Quite a bit of variation in there. Then your return on your investment from your medical expenses through your personal income tax return varies significantly. Again, right at the beginning, if you're $2,000 worth of medical expenses and you're declaring $25,000 worth of taxable income, you get a 25% return. Now, your tax rate at 25,000 is very similar in nature, maybe slightly less in terms of what you're paying in Ontario taxes. So using non-taxable benefits, using corporate care, if you're using non-taxable benefits for your meal allowance, it'll bring your taxable income down. And then the advantage to using your medical expenses on your personal income tax return actually increases considerably, but it doesn't. It at the best it would just top off is at exactly pretty much tax rate. Okay, so it's going to be equal return on your investment at about $25,000 in there. So if you're trying to picture in your mind what systems you use, they're sometimes dependent on other systems. If you're a T4 driver, you have no choice, or I shouldn't say you have no choice. The best choice is corporate care because your taxable income is between 55 and 70. If you're an independent operator, and you're using non-taxable benefits because you're incorporated, you're using non-taxable benefits, your taxable income isn't between 55 and 70, it's actually between 25 and 35, somewhere in that area. Then your 0 to 2 or 3% medical expense ROI is now it's bumped up to between 10 and 20%. But in the end, the best system, you could sit down and figure it out every single year and say, okay, now I'm going to use corporate care, and then now I'm going to use personal income tax return. Invariably, I would say probably 90% of the time, maybe even 95% of the time, it's better to use corporate care. The 5 or 10% where it is so very close, the only thing that you may be out would be the administration charge, like the 5% and the administration charge that corporate care would charge. That would be the only thing you would lose, and that you would have to have the circumstances just so in order to operate like that. That's where it gets a little bit dicey. Yes, you can figure out the numbers each and individual year, but what you're doing is probably saving yourself $30, $40, $50, $80, $100 maybe, depending on the volume of your medical expenses. Like if you have $6,000 worth of medical expenses, you have $300 worth of administration, and you have to figure that into there and figure out, okay, if I have an additional $300 now at $6,000, what would happen now if I suddenly throw in my medical expenses into my personal income tax? Well, you don't have that $300 in there, and so you might get a little bit better, but at the most you get just maybe a couple $100 benefit one way, and then all the stars kind of sort of have to align perfectly. That's not how I personally make financial choices and decisions. I don't micromanage every year's medical expenses because medical expenses, especially for me, even though I'm 60 plus years of age, I've never had medical expenses $2,000 in the last 15, 20 years. In a year, maybe I might, because my wife does some stuff, but I'd say probably 25 years ago when my kids, 20 years ago when my kids were all getting braces and stuff like that, where I had $10,000, $15,000 worth of medical expenses, then I could maybe do it, and it'd be a few $100s. But even back then, what I did was I threw everything through corporate care, because if in doubt, it's going to get under 90% of the time, you're going to get a benefit through corporate care, and 10% of the time, it's either going to be very close or identical, somewhere in that area. So depends how sharp you want your pencil to be, and how big of a number your medical expenses are. Like if you have a $30,000 legitimate expense, well, it might be good to sit down and actually figure it out in a year and see, because then you could figure out maybe a few $100s. But the average household expenses, I think when Margaret was saying that, I know the average household, gives $3,000-4,000 or something like that in medical expenses. I kind of suspect, and this is just my personal feeling, is that that is not necessarily national averages. She would, in her experience, she would have a higher pool of individuals who use their medical expenses more so than the average individual. That's just my guess. Maybe I could have asked her if her pool of people using corporate care would be those who have higher medical bills or not. But it's a guess. That's just national averages. Realistically, I think I've talked to a lot of personal income tax people, and when they talk about medical expenses, they're talking like a $2,000 medical expense for a personal income tax, somebody handing it in. That's kind of rare. That's sort of the peak one. You do have some rarities, but I think they're a little bit of an outlier in there. But if you are an outlier, you should know that you're an outlier. If you have medical expenses above $2,000, you should be thinking through some of these questions and which route you should be taking. And like I said, if it's $3,000-4,000 or something like that, $5,000, more than likely, not, like I said, 90% of the time, corporate care is going to be your answer. Only about 10% would be not corporate care. It would be your personal income tax. Very easy, but the only reason why that 10% might be there is when you are incorporated using non-taxable benefits. And if you don't know what that is, you're not using non-taxable benefits. You're using the TL2 simplified method, and which, in my guesstimation, 98-99% of all accountants use the TL2 simplified method for truck drivers. And so you would have to change what you're doing to use non-taxable benefits. And that means incorporating and very specifically having an employer-employee agreement, following that agreement, everything being auditable from ELD all the way down to the minute book of your corporation. If you have a question about that, by all means, give us a call. We can explain it some more. We have some podcasts on it, and like that's what we specialize in, saving owner operators, lease operators taxes. And the love of my life is non-taxable benefits. That's really the primary way in which individuals save money in income tax. And corporate care, and using corporate care, this system, that again is a non-taxable benefit. Converting taxable income into a non-taxable benefit works great. And I like the feature, for instance, if you don't need it, you don't use it. And if you need it, then you can use it. And the fees are relatively low. I appreciate Margaret's input. And this is a pretty big podcast for a lot of research. It was probably about 3 months into this. So it's a fair bit of work. But if you are at all interested in saving taxes, these are one of the few things that you have to consider. If you have zero or almost no medical expenses at all, you probably you're not even listening to the end of this podcast. But I'm assuming that because you're listening right to the end here, you have medical expenses in your life, and this is definitely an answer for you. All right. That being said, wish you the best. Have a great trip.
If you want to learn more ways to become a professional independent operator, subscribe to this channel. If you want to support what we do, like, share, and turn on that notification.
Thanks for stopping by Making Your Miles Count. For further Making Your Miles Count productions, call us at 877-987-9787 or download us at makingyourmilescount.com.